Good evening, good afternoon. This is Jeff Scott, and this is my weekend review. It is July 27, 2014. It's approximately 4 p.m. on the East Coast, so there are no future updates to talk about. I entitled to this week, Bullish Participation Narrows, Bounce or Breakdown on the Horizon. I'm putting my bet on a breakdown, but I have to anticipate, but I'm still going to do what the market tells me it's doing, not what I think it should do. Here's one of my email addresses. You can also get me at hgsidoc@gmail.com. And let's get going. Disclaimer, this is for educational purposes only. Any recommendation in the spirit of education, not investment advice. I am a doctor, not a broker. Most physicians lose money with their investments. And I am independent, and although I am in close relationships with many different vendors because I've given them money over the years, I have paid for all the tools that I demonstrate. A couple of people, actually one person, seemed to be upset with me last week because I was indecisive, and I gave the reasons for being bullish or bearish and didn't say which way I was going. Well, I think the market sort of did exactly what I thought it would do, which is it can't make up its mind. I think eventually it will make up its mind, and I think we're getting closer to that point in time. I only tell the paid service what I'm doing, not the free webinars that I do. Just kidding, there is no paid service. As always, I like to point out and call out and thank and mention who are the people that I've learned from. And I always like to talk about becoming your own guru. I've learned from some great folks. And the smartest one, or one of the smart ones, Ian Woodward, said he's not a guru. He teaches you to be your own guru. And I think that's what you ought to set as your goal, is to become your own guru. So whether it's Ian and Ron from Woodward and Brown Investing, any of the CanSlim folks from O'Neill to his disciples, Morales and Katcher, who've taken CanSlim to the next generation, Alexander Elder, my good buddy George Lee, who I guess is on vacation the next couple of weeks, a new buddy, John Person, who I've used his tools for a long time, and it just fits so well with my style of investing from a seasonality perspective, from a pullback to support, and different indicators, high close, low close dojis, the use of on-balance volume. Highly recommend him if you haven't read his books or been to one of his programs. Van Tharp for money management, and then you know the rest, Bigelow, etc. I hide my desktop for a reason, and that's because I own a lot of different programs. Reality is I don't use a lot of programs. I use TradeStation, Thinkorswim, or something I talked about last week, Genesis Trade Navigator for real-time charting. I trade with TradeStation or Thinkorswim. Increasingly, I find myself scanning and doing other things with Genesis, which is kind of interesting. From a stock market group analysis perspective, I'm a big fan of HGSI. You'll see why as I use it predominantly. But I also use EdgeRater, seasonal analysis through many different programs, Magenta being one, Best Choice, TradeMiner, and even within Genesis, and now EdgeRater. And a lot of times I'll use MarketSmith to get additional earnings information on some of my potential investments. I always look at this because I keep waiting for us to get into the red circle. And if you've been watching me or listening to me for any amount of time, you know that every time I think we're falling down, we get another leg up. At some point, we're not going to get the leg up, and we're going to go into a bear market. I see a lot of signs that are making me want to become defensive, and I'll talk about some of those signs today, as well as some of the steps that I'm going to take as part of being more defensive. I'm also aware that we are still really in stage 3, near all-time highs, and wondering whether it is another bump to the upside, or are we on our way down? This pattern is repeated over and over again in all time frames. And whether I'm looking at stocks, indexes, sectors, industries, the like, I see this. Now, there are a number of things that I do to help me get a feel of what the market is doing. That's what I go through over and over again every week when I do these reports. I try and make my case of what I think the market's doing and help you understand how I make those decisions, but also hopefully stimulate you to do it yourself. Last week, I was concerned about the lack of volume on the Canaries, but it is summertime, and I thought that perhaps they were getting ready to break out. Well, they did, until Amazon blew up on Thursday. In fact, even Barron's on Sunday basically says that Amazon.com is likely dead money. If Amazon sells off, then that's going to hurt the canaries. There's been strength in the canaries. Apple's been doing well of late, and certainly Facebook and LinkedIn had a good week as well. Netflix had a sell-off after earnings. Net, the canaries are holding on. They still have a pulse. At the March PV meeting, we established a list of leaders. And we use the LLUR, lower left, upper right leaders index, to give us a clue as to when the market is done. Now, interestingly, although it's been predominantly a sideways move ever since we did this index, it's a sideways with a continued uptrend. But for the first time in a while, we closed right on the 50 this week, breaking through intraday the 50-day moving average. We had a MOBO break down from a squeeze. You can see my technicals up above have gone red. On-bounce volume has turned down. There was a pocket pivot to the downside and a kahuna to the downside. We've had small corrections in this index and one bigger one in May. I just get the feeling that, I hate to use the terms, it may be different this time, meaning this may be the time that this index dies. But that's why I said ready to break down with a question mark. Now, the latest index I did was done in June at my meeting. I call that the Florida Summit LLURs. This one is holding up nicely. It has not broken down. Although if you look at the list, SanDisk sold off on earnings. NXP sold off as there's been clear rotation out of technology. Lanet blew up with an FBI or some federal investigation. Even the oral exploration stocks have slowed down. That said, we're still holding above the 8 and the 17-day moving average, and you can contrast the technicals above, mostly green versus mostly red on the earlier list. So this list tells me it may not be over yet, but I'm going to put an asterisk there. I think at some point you do too many lists, you start to do optimization and curve fitting. This list is holding up, but I think the market as a whole is starting to break down, more indicative of our March list. Market themes, the following phrase is still never true. It is different this time. Whatever I say or anybody else says, it's different this time. You need to have the hairs on your neck stand up because it's never different this time. Earnings season still is around. Know your dates. Remember, market tops take much longer than market bottoms. Diminishing bullish participation is certainly concerning as sector rotation is occurring. I quantify certain things for bullish participation. One of the things I look for is a number of stocks with daily and weekly bongos, yes. And typically, in the height of a bull market, I get about 1,500, 1,800 out of the 8,000 stocks in the universe to meet my price and volume criteria, and both the weekly and daily bongos being positive. I think we had 700 today. That's what I see at bottom. So it's very strange when you get numbers that you used to seeing at a bottom of a market when you think the market is rolling over, not when it's recovering. I guess if I was a super bull, I would say, well, it just means it's not really rolling over. I'm not saying that. I think it's a what's the word I'm thinking of? Divergence between the index and the underlyings. What are Ian and Bart Delitio thinking? Well, everybody knows Ian Woodward from HGSI. He's been talking on his blog for the last several days, several weeks about a climax top and then a potentially a correction or a bigger sell-off. I put a lot of weight there. I also put a lot of weight in some of the comments of Bart Delitio. Bart is the proprietor of VectorVest. Smart man, similar to Ian, both have been around for enough years that they've seen a lot of different markets. And when their strategy of the week, which is a Friday night session that they do for people that own their software, is done by Bart talking about valuation in the market, I start to think that I have two very smart gurus telling me that the market's getting ready to roll over. Bart D. and Ian speak much more at market inflections than during the boring doldrums of the summer. We've been climbing a wall of worry, and I've added one in capital letters in seasonality. And I'll show you some things to be concerned about seasonality. The Portugal banking thing has certainly eased off, perhaps not going to make the EU collapse. ISIS, we don't hear about them every day, but I guess as long as you're willing to convert or pay a tax or leave, they're not going to kill you. But ISIS is still a concern. We did see them blow up a holy site that was holy to Muslims, Jews, and Christians alike. Gaza, well, I think Gaza's getting worse. Ukraine's getting worse. Used car debt crisis was something I read about in Barron's last week. That's certainly not getting better. Immigration, well, we know that's not getting better. And I haven't heard, has the female that runs, Karcher or whatever her name is, that runs Argentina, she's figured out whether or not she's going to pay off her debt. But still lots of things out there. What's working? I did about 700 charts this afternoon. The first 10 were all China plays, a lot of China internet plays. So I guess China is still working. Internet stocks not named Amazon, many of which are still working. Midstream and refiners, well, midstream's been strong for a while. They seem to be holding on, and refiners seem to be coming up. Despite what's not been a great time for gold and silver until Friday, there does appear to be strength in the miners. And then continuing on the theme of miners, actually strength in steel plays and iron ore. Future meetings, I just again want to call out that John Person is holding a meeting October 11th and 12th. They actually moved the date so I could speak at it. So it wasn't on Yom Kippur, which was the week before, which is probably the holiest of the Jewish holidays. Haven't really figured out how much I'm speaking, but if you've not been to a John Person seminar, it's at the same hotel that I held my Florida Summit, which means outstanding time. It's a 2-day seminar, and although it's about the same price as mine for 3 days at about $1,100, I believe, although I'm not even certain on that price. If you email, I'll get you the price. They give you 1 night free, so it turns out to be quite a deal, and like I said, it is a great location. Come a day earlier, leave a day later, and enjoy the beach. October 3rd and 4th, I will not be there because of the Jewish holiday, but George Lee is doing an advanced seminar in Orange County. I then want to call out the PV meeting. I may be wrong on my dates. Email Ron Brown if you're interested on that. You notice I've struck out my Vegas meeting. Magenta Traders already got the dates that I want, and Sue McClellan, the MACD lady, MACD Sue, will be leading that meeting, and I know she's got a lot of overlap with my crowd, and I certainly don't want to distract from that. So I will be holding a meeting here in February. Just a couple of questions for you to consider. If you're interested in coming, room rates are going to probably be $349, maybe a little bit less, so they're pricey. I will reduce, so I have several questions. One, would you rather stay at a cheap hotel by the airport, cheap being $200, much less nice of a surroundings, but less expensive? Those that attended my meeting have heard of my meeting. Would you prefer I cut my costs but eliminate all the meals and extravaganzas I put on? And just let me know what your thoughts are before I commit to the date. I'm looking at the first weekend, which would be a weekend and a half, 10 days before the New York Traders Expo. Remind you, big news week, especially on Friday. It's the first Friday of the month, which means we get unemployment, non-farm payrolls, etc. Crude has been moving the market some. Pending home sales, home builders have been selling off hard. I'm not even going to go through this list. If you don't know when your earnings are, shame on you. Just suffice it to say, this is a massive week for earnings. LevittBrothers.com, skip the members/index. That takes you to their main site. And I think you just have to register. You don't have to pay anything, and you could actually download some daily news as well as these earnings dates. So now let's take a look at some of the things of what I think are going on in the market. I can tell you what this will not be today, and this will not be a very long session from the bullish perspective of me telling you what's working and things like that, because frankly, That will be a very short discussion if I want to talk about what's working right now. Let's quickly go look at TradeStation. People know I like to look there and get an idea using my elder indicators as to where the strength and weakness in the market might be. So I'm going to open up I know it's here somewhere, probably right in front of me, elder, single. So what we're looking at are really two or three things. I'm looking at the color of the bar. Blue is sort of indecision, green is bullish, and red is bearish. Now what they really mean is this. Dr. Elder looks at two things. He looks at a moving average, an exponential moving average, which I won't tell you what it is because I don't know what the timing is. And he looks at the direction of the last bar to current bar in the MACD. If both the price is above the moving average and the MACD histogram is moving up, you get a green bar. If you get a green bar, a filter allows you to buy or hold. You should not be shorting on a green bar. If the price is below the moving average and the histogram has moved down, then you'll get a red bar. A red bar is sort of a filter that says you're able to short or hold, but you should not be going long. A blue bar is when one fires and not the other, and it's pretty much dealer's choice. So let's start with a Dow, and you could see what weakness looks like. These are those large 30 stocks, big red candle on Friday. These red dots here signify that we had some MACD divergences, and you could see that as we got higher highs, we got lower and lower MACD histograms. So that showed a momentum was falling, and no shocker, the market had a big drop on Friday. Still blue on the weekly and the monthly, but certainly not a buy signal at this time on the Dow. I also look at the high jump, which is down to 58%. If I look at the Russell, a little bit better, but the Russell had its sell-off and has actually recovered a little bit. Blue on the daily, but red on the weekly and blue on the monthly. So another place that we probably don't want to be doing a lot of long-term purchases. You could see how much the Russell's come down, that its high jump is now down to 22%. If I look at the NASDAQ, I see a lot better than the Dow or the Russell with a doji formation here. Be interesting if there was a gap up on Monday, it would almost be called a morning star, although I'd rather see morning stars at a bottom, not near a top. But certainly an indecision day after a gap down on Friday in the NASDAQ. Blue, blue, and blue. MACD divergence persists on the weekly. It's been worked off on the daily. And you could see this high in MACD was much lower than this high here, and higher highs, but not a higher high on the MACD histogram. Weakening momentum, sell-off, not near the top of the high jump. So with predominantly blue, I would say if you wanted to be buying in the NASDAQ, you can, or you could be shorting. There's no avert signal there. Looking at the ENS for the S&P 500, a lot like the NASDAQ, blue, blue, and blue. MACD divergence off, although still on the weekly. I guess options for participation exist. Here's what's been killed. This is the SOX. Now, one of the avid users of HGSI started a thread today, which is always a great thing. And on that thread, it was a conversation was about whether or not with the SOX hitting sort of the lower band or the lower buckets in the bucket analysis, which we do on a regular basis. She did this on the sectors. Is a time to be thinking about going long the SOX. Not yet, in my opinion. I'd rather see it at least bounce or put it in a base. But she was putting together her shopping list, including things like Intel and Micron. I'd throw SanDisk, RFMD, some of the other leaders, AVGO. But right now, they're all pulling back, and until I see some stabilization here, and I'd like to see some evidence that this is turning around, Right now I'm on a sell signal, or a not buy signal, I guess is a better way of putting it, on the stocks. If I look at the NASDAQ 100, the best of, this is where CMG and some of the other big winners were this past week. And you could see it's holding up near the top of its channel. MACD divergences on daily and weekly, green on the monthly, still lots of blue and green. This is where the strength of the market is. All bite. We'll see how long it lasts. So when I look at this, the best I could say is the NASDAQ, especially the NASDAQ 100, are holding out, but the Russell and others just look awful. The Russell and the Dow are the worst. Now, we'll see if time allots me to come back. I found John Person stuff to be extremely valuable. And during the day, I'm monitoring a number of different things in Genesis Trade Navigator. Fortunately, I have a better resolution on my trading computers, and I'm able to look for various signals. If I look at John's signals, you had a high close doji here, and you traded above the pivot moving averages and got a buy signal on May 2nd. On the ES, you still have a buy signal here. Now, my guess is if we trade down at all on Monday, since we are right at the pocket, the person's pivot moving averages with a doji on Friday, if we trade down below that, we'll generate a sell signal, or we likely generate a sell signal. I also noticed the on-balance volume, which was rising during the uptrend, has pulled back, as has the accumulation distribution on the S&P 500 as well. So it'll be interesting to see. This is on the weekly. On the daily S&P, you could see we already got that red candle on Friday, and very close, if not setting up a low close doji. And again, I'm looking for a sell signal to come in early in the week. You can see on-balance volume is crossed below. This is seasonality, and you could see that seasonality continues beyond the current date, so it's actually giving you a look at the next few days of what you might expect. If you look at what's really weak, if we look, for example, at the Russell, the Russell had a sell signal come in Friday. This is what I'm going to be looking for, breaking underneath the pivot moving averages. On-balance volume failing at its moving average, certainly trending down. And this is the weak small stocks using some of John's stuff. And we'll be looking to see what happens on the S&P this week. Clearly, I think the S&P is at risk. Again, if you look at the Dow, you could see it had its sell signal come in on Friday as well. On-balance volume breaking below its moving average. So I have a lot of concern there. Now, I don't do a good enough job yet, I think, to really talk about it, high close and low close dojis and how John uses them, which is one of the great things you're going to get if you come to his meeting. But one of the things I like about Genesis is one of the only programs that actually lets me, look at what a candle looks like intraday on many different stocks, but I can actually screen for high close and low close dojis using John's stuff. And if I look at high close dojis, which is a buy signal, in the S&P 500, I see all of 12. That's not a big number. And if I look for low close dojis in the S&P 500, I see 36. So more evidence to me of weakening in this market. I do a number of different things on a weekly basis, including scan my own stocks, looking for his buy and sell signals. We'll talk more about John as we go on. Within TradeStation, for example, and I haven't run this today on this computer, so it's not up to date, but I can basically put a big watch list in and then run it for his signals. And what's really cool from my perspective is I can put in a big watch list. And this buy signal number 2 is my favorite because it's a buy signal at monthly support, and the sell signal, sell 2, is a sell signal at monthly resistance. So let's just run those in the background as we go forward. Highly recommend you check out his site, Person's Pivots, HGSI.com. Now I want to look at the market some in my edge rater analysis. Again, if you're here today for me to give you my bullish picks, you might as well turn it off now because I'm not very bullish. But I am going to talk about why I make that statement. So first thing I like to do with HGSI is to run what's called a group performance analysis. This allows me to create many groups of my own. I ran this from end of day Friday to end of day Friday, the 18th to the 25th, and looking at the different groups I put together last weekend to get a sense of the market. So the first thing I see is there's probably as much red as black. We know it was sort of a flat week from a high perspective, so that's important. What else might I want to look at? I might want to look at the S&P 500, which was really flat. It was up 0.01%. I might compare some of my favorite indexes to that. IBD 50 was up 3.2. Blame that one on Chipotle. HGS 100 was up 0.79. My GIF All-Stars were up 0.68. But if you look at them, you see that many of the stocks were losers. In fact, more HGS 100 and GIF All-Stars were negative. If I had left my holdings intact, which really isn't fair because that's not what I do, plus I have a lot of hedging in place, my holdings, if I left them intact, would have been up 0.56% for the week. I think I was up by 1.27 when I took into account my different plays. But of my stock picks, 2/3 of them were positive. Other things that I might look at, Market Smith 250 was up about 1%. And these are some of my favorite smart groups, just seeing that. This one really struck me as a big number, but who was buying PBYI a week ago? Unless you were, maybe Bruce Brotow might have had some over because he has a lot of long-term holdings of cheap stocks in the biotech space. But Puma Biotech went from 58 to 200, 141% return. You had to have this in your account because if you didn't participate in the big up move. I could also look at the list from opening of Monday to Friday close, and I'm not going to go through it, but let's just say that it's not a big difference, so there's no point in it. The Hindenburg, interesting comments I think about the Hindenburg. Those who've been following me or Ian know that the Hindenburg is a signal that's derived from the NYSE. All the NYSE includes the number of new highs and new lows being above 2.2%, a rising moving average of the NYSE, McClellan less than 0, new highs, new lows greater than 2, the number of new highs cannot be more than 2 times the number of new lows. And if you hit all 4 of these, you get a Hindenburg omen. We had it December 6th. We haven't fired an omen since that time. Now, what I think is interesting is we are 38 new lows away from a Hindi signal. We are not firing the Hindi because of the, well, for example, the moving average slope is minus. The number of new highs is 2.78%. The number of new lows is 0.91%. McClellan is minus 9, let's see, the McClellan index, is minus 29. If we get a flush on Monday and we get 38 additional new lows, we are likely to fire a Hindi. Why does this matter? No major correction in the last 50 or more years has occurred without the Hindenburg omen firing. That said, we look for not one, but we look for a series. And if we see a series of these, it's time to stiffen your neck and further evidence that the market might be rolling over. Bucketology. This one's disappointing to me. Here's where we sit on Friday. So 2/3 of the stocks in the S&P 1500 are below the midline, and we're starting to pile up in the lower part and about 10% of the stocks below the lower band. What's disappointing is that a week ago we triggered a signal based upon stretching over 25% of the S&P 1500 were below the lower band, 79% below the midline. Now, since this bull market has begun, every time we had this signal, we had within 3 days, we had a substantial market move. We didn't get that market move. We had a small market move and we're pulling back already. This here is July 3rd. This is the last exuberance day, nearly 20% above the S&P 1500. If I go back to June 9th, we had this date, and then we never sold off hard. And despite sideways, a little bit of sell-off, we peaked in July 3rd or abouts. And here is the last working buy signal on April 11th. Something's changed. Now, my hypothesis has been that a overbought picture like this one here does not work in a bull market. It signifies a sideways and slight pullback. And in a bull market, a profound shift to the left signifies a bottom. My question is, in a bear market, does the opposite occur? And in a bear market, when we get oversold, do we just go sideways for a while instead of correct up? And on a overbought sign in a bear market, is that a run for cover? So I'll do more research. So that's sort of flipping the thought as we go from a bull to a bear. Right now I could say that it looks like this signal has failed, although we were up a little bit this week. From the market perspective, this is sort of the Woody indicator. We look for green as a buy signal, red as a sell, yellow as churn and chop. And we had more kahunas come in on the indices on Friday. It doesn't look pretty. This is pretty. This is pretty. This is pretty. This is pretty. Pretty means easy to make money being bullish. This is pretty too. Easy to make money being bearish. This is chop. And we're in chop, which is a hard time to make money either long or short. George Lee has setups built into EdgeRater. And I only want to pull this up today to show you that you can look at bearish breakdowns as well as bullish breakouts. And so I actually highlighted here the yeses being breakdowns in a squeeze, some of the more bearish appearing stocks on a daily or on a weekly basis. Many of you use Morales and Catcher. They're code blue. Well, this is kind of bearish when you see code blue ending at slide number 44. So these are stocks that are meeting their criteria: pocket pivots, Bible gap ups, forced kahunas, while code reds, a lot more, down to 75, having kahunas to the downside. So we're really seeing a shift in the feel of the market as increasingly we're seeing worsening picture. Now, I mentioned more to come with John Person. John and I are working. Right now, I'm working and trying to convince John it's a good idea, but I think John and I are I can say we're working on it, of creating a workspace within EdgeRater. Allows you to scan the entire market in a moment of seconds, and you can look at the moving averages, pivot moving averages. So what I've done is I looked at daily, weekly, and monthly, and a up means that the daily is above, not the 3-day or the 3-week or the 3-month. So it gives you an idea of the direction of the moving averages. I can scan for high close and low close dojis, and I could look for monthly, weekly, and daily pivots. So what I like to look for are, for example, MUA. Don't know anything about the stock. I do know ATLS. Here's a stock, well, that has a daily and a monthly high close doji. I might want to look later at CBSH because it's got a daily and a monthly high close doji that's occurring right at monthly, weekly, and daily pivot support, or within 1.5%. So I found this to be a very useful tool during the day when I do my updates in EdgeRater of helping me find signals. Also within Edge Rater, for those that have Edge Rater and don't want to spend the $5,000 for a seasonality program, different than Genesis, Edge Rater has built in the ability to take any instrument, and I get 20 years or more data out of HGSI, and then I could look at performance from tonight over the next 2 weeks, 1 month, 2 months, 3 months, 4 months, and so on and so forth, and start to look for things. What I look for are stocks like JDSU. Average move in the next 3 weeks, 3%, up 16 out of 20 years. That might not be that exciting. BCS up 4% in the next 2 weeks, 17 out of 20 years. What I don't want to be buying are stocks that I found it's got enough years that it matters. IPOs don't help you here. So you need to find, well, I think I did this by years. Let me see what I did. I can look by number of positive years, by number of negative years. And what I want to find, what I don't want to see, or what I want to potentially for shorts, are stocks that have mostly negative years over the next couple of weeks. So since I'm not in Edge Rater, I can't really scan it right now, but if I go down to the smaller numbers, what I want to find are stocks that have just a few up years and a lot of negative years. So here is RDWR. Over the next 2 weeks, it's been down 10 out of 14 years, losing 4%. That might be something that I might want to think about. Probably not, but basically the point is you can find stocks and look for outliers, things that have a lot of years one way versus the other, and a movement that you might want to take advantage of from a seasonality play. What probably makes more sense instead of studying the entire market is to look at sectors or industries or potentially your own holdings. One of the things that I did look at was some of the major market indexes, historical performance now, over the next 2 weeks. You don't think the market's supposed to be volatile? Over the last 24 years, 16 years, it's been elevated, average return 9% on the VIX. Do you think this says the market might be volatile? 1 month return of 6%, 2 months return of 15%, and 3 month return from now, 15 out of 24 years positive, the VIX up average of 20%. Rising VIX is bad for making money. To the person that's thinking about semiconductors, buying them at the low, this is a seasonality weak time for semiconductors. Over the next 3 months, 12 out of 20 years to the downside for a minus 4%. Might not be the right time to go into semis. Do you notice any big numbers over the next 2 months in stocks besides transportation to the downside? No, because the sell in May and go away is really 2 parts. You have a sell-off in late May and early June, and then you have a summer rally, and then sometime in July you have a sell-off again, and it may last until October. So as I look at this, the indexes, I expect them to be weak for the next 3 months, except for the VIX. Do I want to be fully margined, long, no protection, balls to the wind? Hell no. I have to take that into account. Let's look at some other stuff. I could look at historical performance of some of the major ETFs. Now, when you start to get 5 and 6 months out, you start to see nice returns. But if you look over the next 2 weeks, you see a lot of materials and I think that's energy to the downside. No big standouts. KRE, I'd have to see what KRE is. I think that's a banking one, up 3%, 6 out of 8 years positive. Gold coming into a strong season, perhaps. If you look at the next 6 months, the average is up 11%, up 7 out of 9 years. So now lastly, I took some time today, and what I wanted to do was start to get an understanding of where I think this market might be going and whether or not I need to buy some protection. No joke, Scolardi. So this is the S&P 500. This is the NASDAQ. And what I did is I tried to identify support. Well, we've been in a straight move up. So I looked at the most recent, on the S&P 500, I looked at the most recent support, which was around May 15th. I looked over here, which was April, I think this was April 11th. And then I looked back here, which was, I believe, February 2014. And what I started to do was start playing around looking at Fibonacci's and others and tried to come up with what I thought might be reasonable targets. So the high of the S&P 500 is 1991 and 39 cents. We're currently at 1978. So, we're 1% below a new high. That's a very strong bullish market. If I do my fibs here, you can see the various corrections, what they would lead us to. I also have listed what I see as the current 8, 17, 50, and 200-day moving average and what corrections would look like from the high. And then I started to play games and look for some confluences. So I have a couple of scenarios. Scenario number one is that we just get a shallow pullback. Perhaps we go down to the 50-day moving average. That puts my target in the 1940s. You could see in green that's the 38% retracement since May. It's the 23% retracement since April. It's about the 50-day moving average, and that's only another 2.28%, or about 2% below where we're at now. That's not likely to hurt anybody, and that would be kind of my high road because I do think we're going to sell off. Target number two, as I look, where was I seeing a confluence? This 200-day is currently at the 1851. My guess is it will continue to rise as the market pulls back. And so somewhere around 1860, which is about 6.5%, and correlates with a 50% off of the 9-month low. I thought that looked kind of interesting. And then potentially an 8% if I get a 62% retracement from the February low and an 8% move down. Now, we know from all of Ian's great work that we're unlikely to get more than an 8% correction. And when we do, we don't want to be long at all. So I look at that and I want to start being prepared for a 6% correction. 1900 gets me to 4.5. 1800 gets me to 9.6. So my medium scenario is we have a 6% correction, and that's what I'm going to start preparing for. I get down below 1800, I'm out of this market. Now, when I looked at the NASDAQ and I did the same analysis, we're currently at 44.49. Our high is 44.80. I thought the first target is, again, the 50-day, which is about 150 off from the high, and at the 23.6% retracement of the April low at 43.30. My 6% is at 42.30, which is a 50% retracement, and sitting right about at the 100-day simple. That's my likely target, about 6% down. And then again, like on the S&P, this is kind of my last stop. And if I get below this 8%, then it's time for me to be out of the stock market fully. So I am, in my mind, expecting a 6% drop in the market. So if my stocks behave like the market behaves, then for every $1 million in holdings I have, I am going to lose $60,000. So if I have $5 million, that means I'm going to lose $300,000. If I have $10 million, I'm going to lose $600,000. And if I'm margined, you can increase those by 50 to 100%. I don't want to give back money. So a couple of my thoughts are, what can I do here? So the first thing is capital preservation. Nobody would be wrong to say, sell everything tomorrow, go to cash, and sleep easier. Now, I may be dead wrong, and we may have a climax run and go up 10% before we pull back. So why would I want to go all to cash until the market tells me to? So that doesn't make any sense to me. I might want to start to put married puts on. I've got those. I've now bought puts, typically in the money puts, on all my major holdings. Now, I pay 1 or 2% of my value for those. That locks in the current price. And then I sell premium by selling calls way out of the money and puts deep out of the money as well. And I pocket that premium to offset the cost of my put premium. As soon as I think the market correction is over or I'm proven wrong that there is no market correction, I have to quickly close all those out or else I lose upside. What else could I do? I might buy contras. So if I looked at, for example, in TradeStation, I have a workspace. And I want to come back to this while we're here. So green is bullish. Well, 3x bears look a lot more bullish than the 3x bulls. I currently own some VXX, some TZA. I've been in SPXS, which hasn't done great for me, and SOXS, which has made me a lot of money for about 10 days now, and I've ridden most of the stocks down, so I may be covering that. As that person on the board was worrying about going long, it might mean it's time for me to think about covering it. So you might want to be buying from some of these. Something to think about. Now, another way of playing these, look at TZA, it's 1564. A 30% move in TZA is about $4.50. If I go up here and look at TNA, 71.25, I'd rather short TNA, where a 30% move is $20. Same move in the market, but a much more profound move in the shares. And just to point out, on Friday, the TNA was down 2.84%, which was $2, while TZA was up 2.9%, which was 44 cents. I'd rather go for the shorting of the bigger dollar ones, but that's all personal preference. What else could I do? I could do some type of portfolio protection. Well, the first portfolio protection to me is get out of margin. If I have short-dated call options that have money in them, I dump them because it's hard to make up time when you drop $2 or $3 out of the money in this time of year. So I want to take those profits if I have them. I buy my contras, but what I also want to do is look at portfolio protection. So these are some of the words and wisdom from a really smart guy who lives in Houston, whose name is David McMullen. So he gave me a presentation in March, and I've updated it with new numbers. So here's what I'm looking at. I'm worrying about a 6% correction. So for every million, I need $60,000 of protection. I can use OEX puts for that 6% protection. Why? They're liquid, they have good spreads, and they make up the majority of any move in the S&P 500. On the OEX, Friday's close was 879.88, and a 6% correction gets me down to 827. Somehow I came up with a projected drop of 62.79. That can't be right. It's 52.79. So let me change that. Or 51.79. So I am projecting a drop of, so I would have to change that to 62. or 52. So let me do that. I like to be close to accurate. So 52 points times one contract. So just because people will be watching this, and I don't know, their audio will be great, I just like to switch this. All right. So I'm going to need about 12 contracts. All right, so I'm going to need about 12 contracts per $1 million on the OEX to protect myself the $60,000. Now, I looked at them tonight, and although the spreads are wide because it's after hours, I went midpoint on the spreads. If I bought 880s, I could buy them for $8.70. If the market trades up, these things will be worth zero. At 871, 872 and 30 cents, so 872.30 is break even. And if the market falls to 827, each of these OEX puts will be worth about $53. So 53 minus 8.7 means it's 46. So I will have protected myself 46 out of the $60 for a price of $8.07. If I bought 870 puts, it would be a lot less money, but I wouldn't protect myself as much. I'd be protecting myself between 870 and 827, or about $43 before I debited my 5 cents. So I'd have to buy more contracts here to be able to have the same protection. If I look at September OEX puts, which I'm probably going to look at, you can see they're quite a bit more expensive because of the extra time. So what I'm thinking of doing is an 880, 830 put spread, a debit put spread, which means I'm going to buy these for $11. I'm going to have an upside of $50. Minus the 11 is a $39 for my 11, and then I'll buy enough of these so that I can get my $60,000 protection per $1 million. Now, I'm not teaching options today. I'm more talking about how I came up with the need for $60,000 per million, how I'm looking at getting that out of OEX puts, and as I mentioned before, I can also protect with certain ETFs. John's great at this stuff. More reasons to come to his meeting. All right. I bet I've already scared everybody off. Let's take a look at the market in HGSI. People who follow me know I'm all about what the market does because I don't care how good of a stock picker you are. If the market blows up, you're not making money going long. You have to be really good. All right, so part of why I'm worried about the market. So let's, before I even get there, so bullish, Florida LLURs still look good. Last week was a positive week, even though I feel icky right now. There's still groups that are working. However, bearish is the seasonality, the wall of worry, and just the gestalt and the feeling that we're starting to see some of the major markets sell off. The small stocks could be leading us out of this to the downside. When I run the market strength, this is the T1, which is waiting yesterday greater than 5 days, but looking at 2 or 3 weeks total. When you see treasuries, the dollar, gold, volatility, commodities, gas up at the top, never good for the bulls. If you look at 5-day performance, volatility was up 5%. T-bill, the treasury bonds were up 1.0. Semiconductors led to the bottom, 4.2, with 2% down on Friday. You look at Friday's returns, volatility led the way, silver, gold, and treasury bonds up. and our stock market, small stocks, leading the way to the downside. So for those that are perma bulls, it's hard to be very bullish right now. I hope I'm wrong. Let's just take a couple of quick looks. So before I get out of this view, we can see that there was a kahuna to the downside on the S&P 500 on Friday. Let's look at it in a cleaner chart. Let's give us some more. So this is the chart that I used in that Excel spreadsheet presentation. And you could see we're clearly, if you want to be bullish, you can be bullish because, boy, we're at all-time highs, or right under all-time highs. Don't like what I saw on Friday, sort of an evening star setting up at an all-time high, cutting through the 8-day exponential. We've done this before and we've bounced, so it clearly is not over yet. I'm just preparing for it getting over. I think the risk of us selling off here is greater. It doesn't mean it has to sell off this week. I still have plenty of longs. I've tried to put in enough short plays so that if the market sells off, I don't lose my shirt and I can pretty much break even on the bad days and still have some upside if we have any good days left. As I get more certain that the market's going to roll over, then I'm going to flip it and try and maximize my return on bad days and protect myself from losing my shirt on good days. So we're in an uptrend, knife through the 8-day. I'm worried, but I may just be a little bit early. The NASDAQ, big sell-off on Friday, doji formation. I'm worried that we're going to knife through the 70 and head down to the 50. On Friday, let's go back to this view. The NASDAQ had a pocket pivot on Thursday and closed down, so actually a pocket pivot down. Look at the on-balance volume breaking down on the NASDAQ, but still, to be fair, mostly green up above. If I look at the Russell 2000, no volume, so you're not going to see anything in force, but you could see it's pulled all the way back to the 200. It's bounced here before. So again, if I wanted to be more bullish, I could say we might still get a bounce. We had a mobile breakdown here, mostly negative up there. I'm worried. I think we go lower, but this could be a natural spot to see a bounce. If I look at the Dow Jones Industrials, this is where I think we're going to be seeing the S&P 500, which is knifing now through the 17, heading down to the 50, and then hopefully we'll see support at the 50 as we have here and here and here, and not a big breakthrough as we saw back in January this year when we broke through the 50 and headed down to the 200. You had a mobile breakdown from a squeeze, a DI crossover to the downside, and a kahuna down, and a cross below the moving average on on-balance volume. So very weak on the industrials as we saw in the elder analysis. If I want to look at gold and silver, they had good days on Friday. We were hoping to see gold bounce off of its support. It traded down to the 200 on Thursday and held, bounced off the 50 on Friday, took out the 8-day exponential on a kahuna. I'm looking to see if we get any bullish follow through this week on gold. I'm still holding a percentage of my J Nugget. I've sold most of it, however. There's a nice return. Silver looks a lot like gold, again, selling down to the 200 and bouncing. Be interesting to see. What really looked bullish, if you're into the dollar, was the dollar actually not. I've failed Thursday to break through the 200 a week ago, or Friday rather, but Monday sort of faked us here and gapped up above the 200 on Tuesday and traded up Wednesday, Thursday, and Friday. This is a big movement. Getting above the weekly 50. Next stop is 22. If the dollar continues to go north, and this is bullish. Look at the greens. Look at the kahunas, the on-balance volume crossover. A rising dollar will be bearish for the stock market. So that would be one thing to watch. And if I look at the VIX, another thing where rising is bad for the stock market. And we can see the VIX still kind of low, but from the low back here, to where we're at today, or to where it closed, it's bounced up 24% in 15 trading periods. And you should remember that on my earlier chart, the VIX is what's supposed to have the power this week. And if the VIX is moving up strong, that's bad for our stock market, which you're all very much aware of. Next thing I like to do is take a quick look at the industry groups. You see we have 196 to start, and we're now down to 14 groups to the upside. That is not a bullish finding. If you look at the EPS rank, you can see these are some of the worst performing from both a relative strength and an earnings per share. So this is junk. In some ways, some of this might be junk off the bottom. If I look at the ones that are moving up, you start to, or moving down rather, some of our favorites: oil exploration, drugstores, integrated oils, utilities, biotech, cable satellite, specialty apparel, home products, a lot of the REITs, banks, brokers, life insurance, more REITs, all moved to the downside this week. So a very bad week for the bulls, at least Friday. So let's take a quick look. Here's precious metals. I think of my favorites of this is probably silver wheaten. You could see, just for the newbies, the magenta is an 8-day exponential. The green is a 17-day simple. The blue is a 50-day simple. And the red is a 200-day simple. The light gray lines are Bollinger Bands. The dark gray line is this one right here, is group strength. You can see the industry group is strong. The bongos are sort of a homegrown momentum indicator. I look to my pullbacks, which will be in an uptrend. The long-term bongo is green and the short-term one goes red. That's a pullback in an uptrend. I have accumulation distribution, elder force, 2 and 13-day and 2 days. This is a proprietary thing at HGSI called the high jump indicator, which is a measurement of extension. When you get the highest high, you're usually going to go sideways or pull back. DI plus minus crossovers, viable gap ups, which we won't see any on gold core here. This is evidence of a squeeze, which you could see the Bollinger Bands getting tight. What it really means is the Bollinger Bands are now inside the Keltner. These are MOBO breakouts looking for momentum in a squeeze. Pocket pivots up and down. Red is bad, blue is good. Kahunas, which are another momentum indicator that we use. Blue is good, red is bad. On balance volume here. And then Eurekas and Phoenix, these are indicators of the market itself. Green is good, red is bad. So we did have a Eureka in the market a week ago, Friday, but I don't see the market. This is on the market itself. Everything else is on the stock. I'm not bullish on the market here. Might be bullish on these. Gold core, a little bit of a pullback. Mobile breakout from a squeeze and a kahuna. I'd like to see it take out the PSAR dot, and that might be interesting. Here's silver wheaten. Very similar pattern, run up. Kahuna, OBV positive, mobile breakout from a squeeze, mostly green up above. Here is American Barracks, same pattern, without being as extended up, pull back to the 200, natural place to rally. So, these stocks have been laggards for some time. Here's AEM, probably looks better than everybody here. Pull back to the 17, it looks like it wants to run. OBV is positive, it had a pocket pivot, mobile breakout. Here's El Dorado, a small gold player, looks like silver wheaten and the others. Kahuna, mobile breakout from a squeeze, everything is green. So if you want to be long and find a bull market somewhere, it looks like it might be in precious metals. Internet-based services, there was a acquisition and then a good earnings in this group. This is Zillow, who's looking to acquire Trulia. This is a stock I just don't understand, so I just have to forget the prices and say what a great buying opportunity here off of the 50 in an uptrend. Had a mobile breakout, everything turned positive in a kahuna. It's getting extended now. It's looking to acquire Trulia, potentially the same pattern. They both came off of the 50. VeriSign, not sure why it's in this group, but Internet computer programming, infrastructure. See everything turned green. It had a viable gap up, which is here, took out its 200. Multiple kahunas, OBV turning positive. That actually looks interesting as well. Gives you an idea where some of the strength in the market is. We'll take a look at LinkedIn. Didn't see that one. And you can see LinkedIn is coming off of a bottom here and then a pullback. Doji is a little bit worrisome, but everything is green. This stock was a great stock. This was my favorite stock to short this year. Every time it ran up to the 50, you had a shorting opportunity on the way down. Now the 50 support. We'll see if it can make its way up to the 200. I've ridden it up off the bottom a little bit. I'm not currently in LinkedIn. Right click back. Next group down is Internet Media. And the top two are awesome. Baidu had great earnings. Don't love its earnings per share growth. It's a China play, part of the China strength. It's at the top of its high jump. Bible gap up, kahunas, pocket pivots, good on balance volume. If you're a believer, a lot to like in the chart. I just think it's kind of extended and expensive. I like Facebook better. I have a big position in Facebook. Saucer bottom, maybe cup handle, breakout on Thursday on earnings. Everything is green. Pocket pivots, OBV is positive. Everything is green. Great earnings per share growth coming in. Big fan of Facebook, the stock. Kind of a little user of the product. Not a fan of Yahoo. It's stalling at the 200-day moving average. Not interested. Qihu looks like it wants to run as well. Had a gap up on Friday with a pocket pivot, OBV turning positive. It's in a pretty deep pullback. It's got good earnings per share growth. Everything's turning green. It might be, if this market holds, this might be a place to play. Again, I believe another China stock. And another China stock that I liked was YY. Unfortunately, I got stopped out of this on my calls about 10 days ago, and I didn't go back in. But it broke out on Friday. Look at the on-balance volume, how strong it is, a kahuna, a pocket pivot, a mobile breakout from a squeeze. It actually does make good money if you go into MarketSmith. And it's got earnings growth. I think the stock is worth about 120 bucks, and it's one that I'm potentially going to get back in. First, I got to see what the market is doing before I even think about other commercial services. I'd call that a throw-in group where they didn't fit anywhere else. And Sotheby's, it's in a downtrend. It did break above the 50. Good group strength. No earnings. I don't like it. Next. Healthcare facilities. I've been talking about Obamacare driving utilization, and anybody that sells services such as drugstores and hospitals are likely to benefit. And some of them started reporting earnings this week. Maybe it was Tenet. And the earnings are good because more people have insurance, duh. So here's Tenet, kind of choppy until last week when it had a big Bible gap up on Friday with the kahuna. OBV's positive, pocket pivot on Thursday. What do people know? Doesn't look that impressive here, but this sector is perking up because people think, here's UHS, sort of a shooting star, don't like that. Here's LifePoint. It closed down after a big move up. There's a lot of initial enthusiasm during the day. I don't like how most of these finished, even HCA, big up day, but it's got a shooting star. So this is all related to potential increased revenue. Steel raw materials, iron ore stocks are hot. I call these bottom fishing because they're well below the 200-day moving average. Here's group strength, but pocket pivot, Bible gap up, broke above the 50, PSAR support, mobile breakout from a squeeze. Do you want to play Cliff or do you want to play Valley? That looks a little bit better, breaking above the 200. Great on-balance volume. Same bad earnings per share growth. I think one or the other might be a reasonable play. These have been showing up now for several weeks. Valley gives you a play on Brazil. Not sure if that's a good play or a bad play, to be honest. Computer storage. EMC. I'm not sure if this is what's driving this necessarily. Maybe it's a cloud play, but certainly a nice move up after a gap up about 5-6 days ago. Lots of pocket pivots, strong on balance volume. makes money with increasing earnings coming in. Might be something interesting to look at. It would have been better to have played it back a few dollars ago. Problem with doing this on Sundays is I missed the rest of the week and talking about it. Data Link, I don't like where it closed. Closed down on the day. I mean, down from the open, but up for the day. OBV moving up. Kahuna, everything turned green. Bible Gap up. Does have some impressive earnings per share growth coming in. I'd have to learn more about it. Net App below the 200, not that exciting. I usually go on the top 10 restaurants. Chipotle's. I played this move here after the bingo. I played this up here, but my calls, I got out of them, and I missed a big move here. I had no idea what this was going to do on earnings. You could see the group strength was weak. Mobile breakout from a squeeze and Bible Gap up on earnings and a Kahuna. But the stock was weak going into it, so I don't really think I did the wrong move, although financially I did. At what point does this stock stop trading at a multiple of 60 and return to its peers? If you look at Buffalo Wild Wings, for example, it too looks like it had a move in sympathy. It trades at a multiple of 36. So CMG's got great growth. It's a great story. They raised prices. They're still selling plenty of product. It's just expensive. Buffalo Wild Wings, an expensive stock, but a lot lower PE than CMG. Don't know much about Zoe's Kitchens, and not a big fan of BJ's Food or their stock. Going back, airlines. Tough week if you're like me and you have Delta. Not a tough week if you're like me and you bought some really cheap $40 puts when Delta was trading above $40. That's what a married put does for me. Going into earnings, I was nervous. I had the married put on. I've got some calls in the mid, I think at 45, and I got some puts at 35 that I actually protected at 32 when it sold off. But United Airlines, late to the party. I guess the ones I really like are Southwest. Look at this nice move up. Lower left, upper right, tight. I like, I'm not sure I love JetBlue to fly on it. I like the pattern. Rough day on Thursday, nice day on Friday. Some of the other leaders, Alaska, oops, wrong one. My bad, ALK. Something bad earnings, sold off hard on earnings, so that one I'm ignoring right now. Delta, just not doing anything, but with my married put and my calls and puts that I've sold against it, I'm protected at 40. We'll see what it does. And American Airlines, the other new one, which had a nice run, doesn't look like it's doing much either. These have been a great place to make money. And if you're a Barron's fan, on the cover it says the airline sell-off won't fly. They're bullish. They don't think the fundamentals support the sell-off. They think airlines go higher. So do I. And then number 10, I mentioned refiners earlier. Take your pick. I don't think this is necessarily great seasonality time for refiners, but they're all looking about the same and they're coming off of lows. So just look at here at the dividend yield. Marathon off of a low, had a pocket pivot. Mobile breakout from a squeeze, pays a 2.1% dividend. Valero off of a low, pays a 2.0. Phillips 66, 2.4. Western is the one I'm in, pays 2.4. Had a nice move last week. Tesoro, I like this one a lot. If I get a PSAR reversal here, I'm probably going to go long here. They pay 1.7. Holly Frontier, coming off a bottom, pays 2.8. Now the interesting two in the group, one's New Star, pays 5.1. Beautiful chart, lower left, upper right. And the other one that I thought was interesting was CVRR. There's got to be something I'm missing here because nobody pays a 15% dividend. You buy the stock for $27, it pays almost $4 an annual dividend. If I go and look at its earnings, I don't know how it supports $4 in dividend. I'm not sure if they got REIT status. They have to pay back all their profits as dividends or 90%. But I'm going to check the CVRR out because I'm kind of amused by its return on the dividend. And then anything else here to look at? That was 10. Still sort of shaking my head about coal miners. I'm not ready to get into them. Walter is sort of one. It was up 2% this week, but sold off a little bit on Friday. Hard to get excited here. It's very similar to ANR, which can be a coal play or an ore play, whatever one you want to give it, because it does both. They're both in the toilet. And then lastly, is there a lastly? Apparel footwear has been strong. I picked up the run on Skeechers. I didn't realize that, this is just everywhere. And, I should have looked at a Wolfpack when Skeechers moved. UA, Under Armour, called out footwear on their call. Big gap up, viable gap up. Deckers, big viable gap up. This is a footwear company. Carter's, I have no idea what Carter's does. CRI, apparel, footwear, other. I thought they were more apparel. They must have enough footwear that they gapped up as well. What I'm in is Skechers, and you can see they had the same move. So a lot of strength in apparel and the footwear part of the apparel industry. As I said, there's a lot of industries to the downside. You've got to be careful. With exploration and production and integrated oils being some of the worst performing groups, it makes me wonder if I shouldn't start to wonder about a contra on the ETFs. And that's something that I might be thinking of, and I believe that would be ERY, Energy Bear 3X. Go back to what we ran a little while ago. If I took my big watch list, I had only, and here's Silver Wheaton, we looked at this one, AUQ, AUY, and SLW, 3 of the 6 are gold plays or silver plays. So that, the strength of metals. Here's to the downside signals. 50 to 6, everything's pointing like we've got some trouble in the market coming. We could bounce. Certainly there could be good news. Israel and Gaza could reach an accord. ISIS could blow themselves up. The world could change, but I'm going to bet that we've got a correction coming. I just don't know when it starts. Therefore, some of the things that I do at the end to look for going long at the market, I'm just going to talk through very quickly. All securities, I often go into sprinters, which is something from David Ghilardi. Brings up some of the technically strongest and fundamentally strongest. Look at the EPS relative to the group rank. Airlines, energy, biofuels, hospital, Trinity, Greenbrier, and the railroad manufacturing have been strong. Shoes, healthcare facilities. So a number of same stocks come to the top here. I also look at pullbacks to free parking. Airline, I looked at these. Was Compass Mineral the one that was interesting? Yeah. What I look for, or what I like to find, are stocks that are in a uptrend. It's a weekly, so it's kind of been not a great uptrend, but since November last year, it's gone from 72 to about 100, and then it sold off. And I want to buy these pullbacks when they get to the 50-day moving average and show me momentum. I had a mobile breakout and a kahuna. So this is kind of what I like to see. I don't love the earnings per share growth. I looked at it earlier and I decided to pass on it. I run, my other favorite scan here is PSA reversal close at a squeeze. So these will be stocks that are squeezing, that are right under their PSAR dot. And several of the things that we like are here. I mentioned Tesoro. If Tesoro trades above so that PSAR dot is at 60.74. So if Tesoro takes out 60, so let's say Tesoro gets to 60.90, I'm in. And why would I do that? Because I can go to work tomorrow on a plane. I actually have a job tomorrow. My wife is laughing at my retirement. I could put a buy stop right above that PSAR dot and put my sell stop, so 60.90 is my buy. I'll put my sell stop, the 200 is at 58.07, so I'll put it at 57.70. So 61 to 57.70 is $3.30. It's about a 6% risk, 5% risk rather. And I put a conditional order. It says if the stock trades above this amount, buy at market or buy limit, however I decide. And then if I buy it, I immediately put a stop. Since my assumption is the 50-day is going to be support, I will put my stop initially below the 50 and try to move up to that 17 very quickly to a break-even stop as soon as I can. If the market sells off tomorrow, if this sells off, I'll never get triggered. But I like stocks that are squeezing right under the PSAR dot. Royal Gold, squeezing at the PSAR dot with the kahuna. That looks interesting as well. Tyson Foods, squeezing right under the PSAR dot. So that's one of my favorite scans. I like to look at big volume movers. None of them really popped out at me today as being a story, except for this one. I don't know why the Royal Bank of Scotland looks so good, but it's doing well. And it's probably something that I might want to investigate. Kind of gappy, ADR-ish looking, but big gap up, kahuna, great on-balance volume, and Bible gap up on Friday. And then lastly, I run my group inclusion filter, which I ran. And we could show you what that looks like here, what the top 30 were. And as you can see, these are the same stocks for the most part, certainly up at the top that we found on our top-down review. I did put together my buy watch for tonight, and I'm skeptical on the market, so that's important. But midstream, refiners, some banks looked interesting, steel, internet, and a lot of these names are Chinese. A lot of these names are Chinese. In fact, if I go to raw combo up here, YY, Qihu, Bipshop, Bit Auto are all Chinese names. So, on that note, I hope I didn't scare you too much. All I can say is Ian has a great slide. I called it chutes and ladders. He calls it snakes and dragons. But the point is the same. When you're a kid, you play a game, and you roll the dice, and you move up. You roll the dice, you move up. Let's see if I can find his picture. And you basically play this game, and if in our on this side of the Great Pond, if you hit a ladder, it's a shortcut up. If you hit a chute, you fall down in the toilet or in the dirty clothes, and you come back down. The goal is to get up to the top. Well, it's the same thing with your money. It's great to find a ladder. It's great to find a snake to get you up there, but don't land on the chute or on the dragon because you'll lose your money. I am long-term bullish. I am short-term cautious. I'm looking for a 6% correction is my guess. It's a guess. It's a hypothesis. It's a yardstick. I am lightly protected, medium protected right now. I will have to adjust my protection up or down based upon what the market does. And I'll make money in a pullback, and you should too, by doing some things I outlined. So y'all have a great week. It's always a pleasure and an honor to do this, although it would be nice to take a week or two off, which I may be doing this summer. But for now, thank you all, and have a great week, and good luck.